Hi everyone, Jeff Yasteen here. Make sure to click the subscribe button. Also, if you like this video on YouTube, don't just hit the thumbs up like button, hit the share button as well and repost it to your own Facebook or Twitter feed. Let's spread the word. Now, I wanted to give you an idea of how I look for stock ideas. So today, I thought I'd let you in on one that I like. Now, it is a speculation only. If you look at the profitability of this company, it has none. If you look at the industry this company is in, it's terrible. If you look at a long-term stock chart of this company, it is also terrible. But I think this company has huge upside potential that almost no one is seeing, and I see only minimal downside if this trade does not work out the way I am expecting. So here's the company, RNET. RIGNET, the symbol is RNET. I told you it had a terrible stock chart from a long-term basis, that is. But if we go in a lot closer with the daily chart, it does look a lot more interesting. This is a stock that's risen from about $1 to more than $4 in the last 3 months or so. And I think the shares could double in the next 6 months again, and I'll tell you the reasons for that in a moment. Now, most of the time, I don't advise buying super low-priced stocks like this one is. They're not really worth the risk, in my opinion. But I'm making an exception with RNET because I think the risk is worth the reward. Now, everyone has their own method of speculating and investing, and I'm not really interested in for myself, what the stock will do tomorrow or next week, but rather next month or the next 3 months. So if I were buying it here, I would have my stop at around $2, $2.50 or so. That is quite a distance from the current stock price, I agree. But the stock also has a lot of upside volatility, upside momentum. So basically we're risking 50% downside, but that also comes with the chance that the stock could double or triple. So if 50% downside means too much risk for your portfolio, just cut the number of shares you'll buy by half or even less, whatever will allow you to sleep at night. Now, the way I look at it, with many stocks, the biggest risk, the biggest mistake that many of us make is not giving them enough wiggle room, not allowing them to do the normal back and forth, up and down, that all stocks do day to day, week to week on a more or less random basis before they really take off and we have significant profits. Investing in the stock market carries risk, whether we're talking about individual stocks, ETFs, or mutual funds for that matter. It all carries a degree of risk. And the higher the volatility of a stock, the more it's moved up, the higher the potential risk as well, because we buy it and suddenly it reverses for whatever the reason. Obviously that can mean large losses. So we always have to be aware of that. And that's why I always suggest buying a lot fewer shares and focus on what you can lose as much as what you can gain, so that you're not scared out of the shares too quickly and you allow them room to maneuver on that day-to-day and week-to-week basis, because like I say, all investing carries risk. So with RNET is a provider of communications and networking services to the energy industry. In many ways, it is the quintessential Internet of Things stock. Many of us have sensors in our homes and our cars that send us alerts and help us be more efficient. And energy companies have been doing the same thing in recent years, adding sensors to pumps and switches, valves and engines. And RNET services connect all those sensors together so companies can see how their production systems are working. But RNET is in the the energy industry, which has been toxic for many investors, for all of us really, as oil prices have gone down, down, and down. Now, I've been following the company from a distance for years, and I always thought they had a bloated cost structure and profits have been few and far between as well. And certainly the stock chart reflects that reality. So what changed? Well, one clue is in the stock chart itself. Back in June, the shares suddenly sprung to life, and it's been rallying higher in fits and starts ever since. Now, sometimes these things are just a fake out before the stock heads lower still. But I like to investigate these kinds of situations to see what's up, because sometimes it means that a beaten up, way out of favor company may be making important changes that will affect its profits in the future. Those changes may not show up immediately in the form of higher profits, but often you'll see the stock rally higher anyway. And why? Because, as you will hear me often say, stocks move higher in advance of future events. They also move lower if those events turn out to be bad. But when I look more deeply at the shares, here's what's interesting. In June, RNET announced a deal with Microsoft. Now that deal is a co-selling arrangement. On the face of it, probably not that important. The most important part to me was the headline. RNET expands reach to outside the energy vertical. The vertical in corporate lingo means the sector or main business focus of a company. So this announcement shows that RNET is looking to provide communication services beyond just the energy sector. Now that's huge because it opens up a whole new set of customers. Another clue, in March, RNET signed a contract with the U.S. General Services Administration to provide communication services to parts of the federal government. The final clue, which really got RNET stock rolling higher, came in late July. RNET said it was partnering with CACI, which is a major defense contractor and also a publicly held company. CACI provides communications, computer, and engineering expertise to the Pentagon, as well as federal security agencies like the CIA. So CACI is a major defense contractor. So if we put all of those clues together, we can suppose that RNET may have a new, potentially lucrative stream of revenue coming in that didn't exist before. Now, RNET's press releases do not indicate the size of the contract. So whatever the size, it can still be very important to the company because when a company has huge, important partners with lots of credibility, like Microsoft and CACI, it tends to make it easier to sell a product or service, especially a new product or service, to other big companies. And I think that may well be the case here. Now, if that were all that was happening here with this company, I'm not sure that I would still be wanting to tell you about it. But I also like the focus in the last few years on cutting costs. Now, cutting staff, looking for ways to do more with less is drudgery, whether it's on a household basis or corporate basis. No one likes to do it, and that's why companies without a lot of discipline in this department don't get serious about it until their backs are against the wall. And in RNET's case, that focus on costs over the last handful of years is starting to pay off. The company is still posting bottom line losses. It will likely post a loss of around 40 cents a share this year. But other measures that deal with cash flow and operational profitability ratios are starting to improve. So this potentially sets things up nicely for future earnings announcements. The one thing that really, that Wall Street really loves and that really gets institutional fund managers interested is when a company starts reporting better than expected results on a consistent basis. So if they report smaller than expected losses, that's good. If they report larger than expected profits, of course, that's even better. But the point is, when analysts consistently underestimate what a company's quarterly numbers are going to look like, it usually means that there are good things happening under that company's financial hood, so to speak. So lastly, let's remember that RNET's main business for the time being is the energy industry. Now, major oil companies, major energy companies are its biggest customers. As they have cut back on exploring for oil and production, they've cut back on the number of rigs in operation. And according to this chart from the U.S. Energy Information Agency, there is a record low number of all rigs in operation in North America and indeed worldwide right now. But if global energy demand picks up as fears of COVID-19 begin to wane in coming quarters, oil consumption has a good chance of going up and going up a lot. That means higher oil prices and more pressure on oil companies to get more of these idle rigs back into production, all of which means more business for RNET that is not yet baked in to the stock price. So that's something you have to keep in mind, is where a company has been, where its industry has been, and where it's going. So in many cases, we are making a reasoned judgment on a bottom in an industry. So you have to look at that aspect, the background of whether an industry has been in decline and whether there's a good shot that that industry's future outlook may be about to brighten, even if that's not yet reflected in the current set of data that's coming out. So there are risks to owning the shares, yes. On the other hand, 2 years ago, this was a $20 stock. 5 years ago, it was a $50 stock. So depending on your time frame, there's a great deal of upside if we get it right. And as long as you're careful about the number of shares that you buy, there's only minimal downside if we're wrong. That's the way I like to look at these sorts of things. Tell me what you think. And make sure to hit those subscribe buttons and follow me on social media. I'm Jeff Yasteen.